Right now at 4:25 a.m. London time, Australian dollar to US dollar is sitting at 0.72379, and I have to tell you straight, this chart is screaming danger. Overnight we printed a textbook false breakout above 0.7260 on the 4-hour chart, and the reversal candle that just closed is a bearish engulfing pattern with volume surging. Most retail traders are still trying to buy the dip. I'm going to give you the exact price where I'm selling, where I'm placing my stop, and 3 full trade plans you can execute in under 2 minutes. Stay until the end because the aggressive strategy aims for a fast 40-pip move that nobody is talking about yet. Let me give you the bottom line first. Australian dollar to US dollar is in a short-term downtrend on the 4-hour time frame. The multi-day range between 0.7264 and 0.7228 is breaking lower, and I expect a sweep of the Asian session low at 0.72279 within the next few hours. As long as price stays below the 0.7254 intraday resistance, that's the 60-minute MA20, the bearish structure is intact. A clean break of 0.7227 opens the door to 0.7196, which is last week's value area low. The liquidity is sitting right there. If that goes, 0.7170 is the daily MA20 magnet. This is not a drill. The Australian dollar is facing a triple headwind: a strengthening US dollar, collapsing iron ore prices, and fading China stimulus hopes. I'll unpack each of those, but first, let's read the chart structure because price never lies. Technical deep dive shall be the first to look at. Pull up your 60-minute chart. As you can see, we have a clear micro distribution phase forming. Yesterday during the US session, price spiked up to 0.72638, which is the intraday high you see on your screen. That level kissed the upper boundary of a descending channel that's been in play since the 0.7286 May 7th high. The rejection was immediate. Right now the 60-minute candle sequence shows 5 consecutive red candles with higher lows being swept. MA5 on this time frame is at 0.72545. But price is already trading below it at 0.72353 on the last tick. That's a bearish flip. The MA20 on the hourly sits at 0.72484, also broken. We are literally carving a mini bear flag here. The measured move target of that flag structure? 0.7225, almost exactly the Asian low. So the pattern is mature and ready to complete. Now watch the MACD on the 60-minute. The signal line has crossed below the trigger, and the histogram bars are printing negative for the first time in 24 hours. The MACD value I'm seeing is around 0.00188 on the long side and 0.00162 on the short, practically flatlining around the zero line but tilting short. This is a momentum divergence from the price high at 0.7263. Price made a higher high but MACD made a lower high. That's a classic top signal. Move up to the 4-hour chart. This is where conviction builds. The May 7th candle closed at 0.72580, a doji, and the very next 4-hour candle is the drop you see now. On this time frame, the KDJ indicator, shown on your screen as K62.93, D64.40, J53.99, just completed a bearish crossover with the J-line plunging. That signals the end of the corrective bounce. The MA5 on the 4-hour is at 0.72545, MA10 at 0.72530, MA20 at 0.72484, and MA60 at 0.72277. Notice the MA60 is almost flat, acting like a midline of this whole consolidation. Price just broke below the MA60 cluster, suggesting the consolidation phase is over and a directional leg is beginning. The previous support at 0.7236 is now being tested. If this 4-hour candle closes below 0.7236, and it looks like it will, the next 4-hour candle could easily target the 0.7212 level that was the breakout point on May 5th. Let's look at the daily chart, because this is the true battlefield. On the daily, we have a rising wedge formation that's been building since the 0.6787 low in late April. The upper boundary sits near 0.7285, and price just kissed it and failed. The daily MA5 is at 0.72044, MA10 at 0.71855, MA20 at 0.71631, and MA40 at 0.70685. Observe the alignment. All moving averages are still in bullish order, but the price to MA5 spread is almost 35 pips, which is stretched. That gap tends to close violently. The MACD on the daily is still positive at 0.00673 but starting to round over. The histogram peaks are shrinking. If we get a bearish MACD cross on the daily in the next two sessions, this becomes a multi-week down move. The weekly chart gives us the broader context. The MA5 on the weekly is 0.71650, MA10 0.70608, MA20 0.69761, and MA40 0.67618. Price is hovering above all. Weekly Mars, so the primary uptrend from 2024 is intact, but we are seeing a corrective wave that could retest the MA20 weekly near 0.6976 before the bigger buyers step back in. I'm not calling for a collapse to 0.68 yet. I'm calling for a 100 to 150 pip correction within the weekly uptrend. Let's concrete the key levels. On the downside, immediate intraday support is 0.7228, the Asian low. A break of that targets 0.7205, then 0.7190, which is the April 28th swing low on the 4-hour chart. Below that, 0.7170, the daily MA20, and 0.7143, the April 30th bottom. On the upside, the first resistance is the broken hourly MA20 at 0.7248. Above that, 0.7254, today's volume-weighted average price that's capping. The critical bull or bear line is 0.7264. A daily close above that negates the bearish outlook and says the wedge is breaking higher to 0.7330. That's the scenario you need to hedge against. But given the evidence now, shorts are dominant. Now why is this happening right now? Overnight we got several pieces that matter. First, US Treasury yields ticked up again after a mixed PPI report that showed sticky services inflation. The 2-year yield rose 5 basis points, giving the dollar a bid across the board. The DXY pushed back above 102.5, which is a direct weight on AUD. Second, iron ore futures in Singapore plunged over 3% during the Asian session. That's a massive headwind for the Australian dollar, given that iron ore is Australia's largest export. The trigger was renewed concern that Chinese steel mills are cutting production amid soft property demand. Daily and iron ore also fell sharply. So the correlation is alive and well. Falling iron ore equals a weaker Aussie third. The Reserve Bank of Australia minutes from the May meeting were released yesterday, and they struck a cautious tone. The RBA noted that while inflation is sticky, household consumption is weakening faster than expected. Markets interpreted this as a signal that the RBA is closer to a pause than a hike. Rate futures are now pricing only a 30% chance of one more hike by August. That repricing has removed the rate differential support from the Aussie Fourth. Institutional positioning data, COT report from last Friday, showed leveraged funds flipped to a net short position in AUD for the first time in 3 weeks. That's a sentiment shift. ETF flows out of the Australian dollar ETF, FXA, totaled $47 million over the past 2 sessions, confirming the smart money is de-risking. Putting it together, a stronger US dollar plus collapsing commodity prices plus a dovish-leaning RBA equals a short-term bearish cocktail for Australian dollar to US dollar. The weekly bull trend is not cancelled, but the correction has legs. I expect this down move to last another 1 to 2 weeks, potentially taking us to the 0.7100 to 0.7070 zone where the weekly MA10 and 200-day moving average converge. The main risk to this view is a sudden China stimulus announcement or a huge miss on US retail sales that sends the dollar tumbling. So Friday's US retail sales print is the binary event to watch. Now, even though today's package is focused on Australian dollar to US dollar, I'll briefly tell you how this fits into the larger Forex matrix, because everything I teach is about capital flowing across assets. While Australian dollar to US dollar is selling off, the US dollar is gaining against most commodity currencies. NZD USD is following the same pattern, and US dollar to Canadian dollar is trying to break its 60-minute resistance. Euro and pound are relatively stable, which suggests the dollar strength is not universal. It's specifically targeting the commodity block. That makes sense given China fears. If you trade pound sterling to US dollar or euro to US dollar, watch their own stories, but know that this Aussie weakness is a canary in the coal mine for global growth sentiment. If Australian dollar to US dollar breaks 0.7190, I'll start looking for euro to US dollar to weaken as well, because it would signal a broader risk-off shift. But right now, the dollar strength is channeled through the raw materials currencies. Use that for cross-confirmation. Kindly remember to subscribe my channel before coming to trading opportunities. 3 precise strategies. Alright, let's turn analysis into profit. I'm giving you 3 risk-defined strategies. No vague sell on rallies. These are execution-ready plans. Strategy 1. The conservative approach, high certainty, small size, for those who want to wait for the cleanest confirmation. Wait for a 15-minute close below 0.7227, which is the Asian session low. Once that candle closes, set a sell limit order just below that low at 0.7225. Your stop loss goes above the 1-hour rejection level at 0.7256. That's a 31 pip risk. Your first take profit is 0.7201, just above the round number and 24 pips away. Your second target is 0.7190, which gives you a 35 pip reward. That's a risk-reward ratio of roughly 1 to 1.1, but the win rate is high because you're trading with the break of a clear liquidity level. If price hits TP1, move your stop to break even. The setup fails if price instead breaks above 0.7254 on volume before your entry triggers. Then the breakdown is invalid and you stand aside. Strategy 2. The standard approach, balanced risk-reward. This is the setup I'm personally taking. We use the pullback to the broken hourly MA20. Entry is a sell limit at 0.7246, which is the area where the 60-minute MA20 and the declining trendline intersect. Place your stop at 0.7266, just above the overnight high of 0.72638, giving a 20 pip stop. Target 1 is 0.7227, 19 pips, equal to risk, and target 2 is 0.7205, 41 pips, a 2:1 reward. This trade relies on the bearish trend resuming after a brief dead cat bounce. The reason this level works, it's the VWAP of the US session and the top of the bear flag channel. If filled, set an alert at 0.7236, the midpoint, to move stop to entry once we break below. The invalidation is a 4-hour candle close above 0.7264. If you see that, cut the trade immediately. Strategy 3. The aggressive approach, fade the bounce, high risk, for tight stop scalpers. Price is currently 0.7237. I want to sell with a very tight stop if we see a spike into the 0.7250 area with a bearish 5-minute engulfing candle. Entry is 0.7251. Stop loss is extremely tight at 0.7259, just 8 pips. Target is 0.7230 for a 21 pip gain. Nearly 2.5:1 reward to risk. This is a momentum scalp playing the rejection of the intraday VWAP. You are betting that any pop gets faded instantly. This strategy demands rapid execution and screen time. If the 5-minute candle closes above 0.7255, the trade is off. This is only for professionals who understand that aggressive exposure can hit stops quickly. Size accordingly, max 0.5% risk. Now, before you place any of these trades, I want you to think about position sizing. Say your account is $10,000. A 1% risk is $100. If your stop is 20 pips on a standard lot, that's $200 risk. So you would trade half a lot on the standard strategy. That's how you stay alive. Never risk more than 2%, and I personally never risk more than 1% on a single currency pair. Also, check the economic calendar. US weekly jobless claims are out in a few hours. If your stop is tight, avoid having an open position during the release unless you're prepared for slippage. Data spikes can shred tight stops. Let me be brutally clear. Every trade I show you is a probability, not a prophecy. You can do everything right and still lose. That's why the stop loss is the most important price on the chart. If your stop gets hit, you walk away, you reassess, you don't revenge trade. Single trade risk should never exceed 1 to 2% of your total capital. When you have a winning trade, trail your stop to lock in gains. Never let a profit turn into a loss out of greed. And before any high-impact news release, either tighten stops dramatically or close the position. The market can gap. Protection of capital is the only thing that lets you play the next setup. So to summarize today's Australian dollar to US dollar conviction, the intraday structure is bearish below 0.7254, with immediate targets at 0.7227 and 0.7205. The fundamental backdrop, iron or plunge, RBA caution, stronger dollar, gives the downside momentum credibility. The weekly chart still looks higher in the medium term, so this is a correction trade, not a trend reversal. Trade it accordingly with tight risk. Tomorrow, the spotlight shifts to US retail sales and the University of Michigan consumer sentiment. A retail sales miss could cripple the dollar and rescue the Aussie from its wedge breakdown. A beat would accelerate the move down to 0.7170 and possibly 0.7140. So candle close Friday will be critical for the weekly trend. I'll be here at the same time breaking down every relevant level across all 8 assets. Before you leave, I need your take. What is your personal bull or bear line for Australian dollar to US dollar today? Drop it in the comments. Something like I'm bearish below 0.7260 or I'm buying at 0.7210. I read every comment and often pin the best analyses. Also, if you find these daily deep dives valuable, hit that like button so the algorithm knows to share this with other traders who need it. Subscribe and ring the bell. I've got gold, oil, euro, cable, and Bitcoin coming in the full package. This is Alpha Market Meridian saying, trade less, time better, manage risk, and I'll see you in the next breakdown.